and welcome to the Week in Markets. I'm joined by Sebastian Mackay, Investment Director, and we're going to talk through the main events of this week. And it certainly has been a busy week over the last 9 days, where we've had the UK budget, the US election, and we've had central bank meetings from the Bank of England and the Federal Reserve. So let's get into it. Seb, let's start perhaps with the US, where we had the US election, which certainly has dominated markets and has had significant implications in terms of what we think about the economic and political landscape going forward. Can you just talk through the initial reaction?
So over the last month or so, market participants have come to expect a Trump victory, and it was really becoming a question of how large that victory would be, whether it would be a complete Republican sweep of the whole of Congress. We still don't know the full outcome of that, but it looks increasingly likely that it will be a Trump sweep. In terms of the implications for markets, I guess the key things are that we expect the corporate tax rate will be cut further, so possibly from 21% to 15%. So that could have a significant positive impact on equities, boosting earnings over there. Also, because we think that the Trump administration will likely be fiscally expansionary, that could have an upward impact on interest rates. And we've already seen over the last month or so almost 1% of interest rate cut expectations priced out of the market over the next year or so. So that's had quite a large impact. In terms of the impact on the Federal Reserve, as I mentioned, it does seem likely that they won't be able to cut interest rates as aggressively as they might have done if it hadn't been a Trump win. And so we did see an interest rate cut yesterday from the Federal Reserve of 0.25%, but it looks increasingly likely that we may see a pause in interest rate cuts at one of the meetings coming up.
Yeah, but I suppose thinking about Trump's policies, they have been very market friendly in terms of the equity markets, and we've seen equity markets really rally following the election.
Yeah.
A bit more volatility still within the bond markets. They've as you said, had to reprice over the last month, interest rates cuts being priced out because of the strength of the economic data, but his policies, which really talks to more fiscal spending, tax cuts, it's not bond market friendly necessarily.
And we're going into this election with a fiscal deficit of about 7% of GDP. Yeah. So the deficit is already quite large in the context of a strong economy. So it's quite an unusual situation. And then on top of that, there's the proposals for tariff increases as well, which could be inflationary. So that's another reason to push bond yields higher, and that's what we've seen. We'll see how many of it's always quite difficult to ascertain exactly what of the proposed policies coming from Trump will actually be enacted, but we'll see over the next few weeks.
Yeah, and I suppose another area that's been very strong in terms of market performance within equities has been the smaller cap, the cheaper stocks, which benefit from tax cuts, but also the potential of just a rollback in terms of regulation as well.
Yeah, particularly banks or financials in general. So that prospect of lighter touch regulation with the Trump administration has been a significant boost for the small cap, and financials and banks have quite a large weight within the small cap universe. So I think on the 2 days after the election, we saw small cap outperform the S&P by about 5%.
Yeah.
So significant outperformance.
And in terms of just moving to the Federal Reserve, they did cut interest rates, but they are challenged somewhat by the different environment that that the economy will be in, given that Trump's will be elected in January, and the policies that will come through. How are they discussing the new policies?
Yeah, I think they try to play a bit of a straight bat when it comes to discussing the impact of Trump, but I think they probably will just be accounting for larger fiscal stimulus than there might otherwise have been. But in terms of the kind of political considerations, in terms of Powell, Chair Powell perhaps being replaced as the Fed chairman, he was very quick to rebuff that. His term does come to an end in May 26, so he may be replaced at that point, but it seems quite unlikely that he'll be replaced before that. The argument is that Donald Trump is famously keen on lower interest rates and would like to have members of the Federal Reserve who are pushing for lower interest rates.
So we had low interest rates in the US. Markets expecting probably about 3 interest rate cuts of 0.25% between now and the middle of the summer, late summer next year. I suppose thinking about the UK, Bank of England, they also cut interest rates by 0.25%. What comments would you give around the situation with the Bank of England?
Yeah, I mean, the growth picture hasn't been anywhere near as strong as the US and the UK, so the motivation for cutting interest rates is probably stronger in the UK, and also the latest inflation number was below target. So that in a way the Bank of England have a green light for cutting interest rates. The only kind of spanner in the works was the budget last week, which is expected to have near-term quite a large fiscal stimulus, so about 0.75% of GDP, the Bank of England estimate upward impact, and also an upward impact on inflation as well, so about 0.5% there. So that probably tempers to some extent the extent that the Bank of England can cut interest rates. We do still think they will continue to cut interest rates given that growth and inflation picture, but there is that slight adjustment needed because of the impact of the budget.
So the initial reaction or assessment from the Bank of England is slightly stronger growth over the next 12 months, perhaps a little bit less growth in 2026, which is a long way away, slightly stronger inflation, so a little bit more patient in lowering interest rates on the whole.
Yeah, I mean, a key area of concern for the Bank of England has been the strength of the labour market and particularly kind of residual wage pressures. And so the increase in national insurance contributions made by employers announced in the budget won't help with some of those concerns, although it's questionable what the impact of that increase will be. It may be that actually it's offset by a reduction in wages. And in a way, that just reverses the cut in employee national insurance contributions that was made under the Jeremy Hunt budget.
So it's quite a contrast if you think with the UK and the US, where UK companies might have slightly less money to actually increase wages, whereas in the US, tax cuts, greater profits should really help stimulate greater wage growth going forward.
Yeah.
Super. In terms of the market reactions following the Bank of England, pretty positive in terms of the gilts.
Yes. Yeah. So gilts have been under pressure since the budget. The combination of that fiscal stimulus, the impact on growth and inflation in the near term, and the extra borrowing, the quite large sums of extra gilt issuance that's going to be happening over the next year or so. Well, actually, for many years going forward. That kind of slightly unnerved the gilt market. It was nothing like the same extent as the 2022 mini budget that really had quite a significant impact on the gilt market, but it did lead gilt yields to move higher. However, I think, in the big scheme of things, the impact on the gilt market has been quite muted, and the fact that the Bank of England is pushing ahead with interest rate cuts, and the fact that actually the impact of the Trump win in the US has actually been quite muted on US Treasury yields. That's led to some kind of calming down of some of those fears in the gilt market.
Excellent. Well, thank you, Seb. And that's everything from us today. Thank you all for watching. Have a great weekend, and we'll see you next week.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.